Mike Tedeschi, Wealth Management Advisor with Perspective Wealth Planning. With this week's market breakdown video, we're going to take a look at the four major U.S. indexes. We're going to take a deep dive into the U.S. dollar as there's been some movement there. We're also going to take a look at some breadth readings, and we'll take a look at the new highs versus new lows on the New York Stock Exchange and what that could mean for us moving forward. So let's jump right into it. As always, guys, if you like this content, please subscribe to our channel so you can see it on a weekly basis. Let's first and foremost talk about the concept of how markets move. Markets do not move in a straight up line, right? They usually do kind of a 2 steps forward, 1 step back, 2 steps forward, or vice versa, 2 steps down, 1 step on the retracement, 2 steps lower. All right, if we look at the S&P 500 up here, I've got 5 years. If we go from this low right here to this high zone right in here, you'll notice a 50% retracement is about where that low is. So what I mean is we get 2 steps forward, 1 step back, 2 steps forward type of movement. Now, obviously this year we had a very sharp sell-off in the beginning of the year, but we have made a very nice bounce. The idea that the market would just continue straight up without any sort of pullback, any sort of correction, just kind of goes in the face of how markets typically tend to work. So if we use that 2 step forward, 1 step back type of mindset here, a 50% retracement off of this move would put us back around that 2,900 zone on the S&P 500. There's also a lot of price action at that kind of level there as well. So it wouldn't surprise me if we continue to sell off going into the election with a lot of uncertainty and other things that are happening, to have a deeper correction, so to speak. But it still wouldn't break the long-term uptrend until we really started getting kind of below those zones, right? And if we look at where we're at currently on the S&P 500, we have a little bit of an additional sell-off here overnight. I'm recording this before the market opens Thursday morning. We're actually closer to about that 3,200 level at the moment. But that has been that key zone in on the S&P 500. This whole area really from 3,300 down to 3,200 is that support zone at the moment. So as long as it holds here, we're all right. If it decides it wants to continue to pull back, look where that next zone of support is. It's pretty much right at that 50% retrace level that we just drew out around that 2,900 zone, and that would be a perfectly reasonable move for the markets to make. We take a look in at the Nasdaq here. All right, it is sitting on its zone of support right at about that 10,700 level, which goes all the way down to about that 10,355 level. This is really going to be that area that the bulls need to hold, and if that doesn't hold, we really don't have much support until we fall back towards those previous highs that we broke out from February and June. So that would be about that 9,500 level there on the Nasdaq. We take a look in at the Dow. We've had those lines laid out for quite some time. 26,000 is a major important level. Below that, we have that 25,000 level, and you can see that major zone of support that's in there as well. The Russell 2000, of course, we're talking about those 50 zones. It's like 1350 would be that next major support zone. It did lose 1450 here overnight. I think we're at about 1440 at the moment. So been weak, stays weak, continues to be weak. We next want to take a look at the emerging markets. All right, the emerging markets, and we talked about this a number of times here in the last few weeks, that if it were to fail up in this zone, this would be bad, as it would potentially be a lower high, kind of essentially looking towards a double top. If it kind of loses this zone in here, you really don't have support until back in here. And what we wanted to pay really close attention to when we're talking about the emerging markets, of course, is what the U.S. dollar is doing, which has a big impact. And the U.S. dollar here actually has kind of put that potential short-term bottom in play. Right? We talked about this zone in here being a potential inverse head and shoulder pattern if it did break over that 94 zone, targeting that 96. And a failure up here would, of course, targeted that 91. But so far, really bullish action in the U.S. dollar over the last 3 sessions. There's still a ton of overhead resistance, and we're actually going to take a look at some data points on the U.S. dollar when it makes a new move over the 50-day moving average after being more than 3% under its 200-day moving average, which is what we've got taking place yesterday. The numbers actually are not great moving forward for the U.S. dollar like one might think. Let's take a look at that. So when we look at this data set here, we'll see that actually 2 months out, we're actually looking at the dollar only being positive about a third of the time. And this has got a bunch of different data sets going all the way back to 1975. 3 months out, 6 months out. 1 year out was slightly positive, but still below your normal random period of time. So it's actually, while you would think that, rally up over that 50-day moving average for the first time, things might start getting going. If you actually look historically at the data points, you have a failed rally a high percentage of the time off of the U.S. dollar. And so what we're looking at from a technical standpoint is, can it get back up over that 95.73 area, that 96 zone? And when we look at this on a weekly chart, we really want to see if it can get back up to this resistance zone of 96, right? And move up over that 94, and that breakout that we've had right here still has not gotten over the major resistance zone, and that would really be where, if we got above that, then I would think that the dollar move could have some legs to the upside. But as long as it stays under that 96 zone, there's a potential for this to be kind of a failed rally, and we can see that from the data. Now, the next piece of data I want to take a look at as new highs versus new lows, U.S. Stock Exchange. So when we take a look at this chart, we can see over the last couple of days, we finally ticked back into negative territory, which we hadn't done since May. And so that is important to note, that more stocks are making new lows than we're making new highs. And when we look at the breadth readings in and of themselves, we can see that the Nasdaq McClellan Summation Index continues to head lower and is below that 0 point. So breadth readings out there have not been good at all. Now, what's really interesting to note is when we actually look at the data points of the S&P 500 ending its streak of more than 80 days with new highs greater than new lows going back to 1962, the data points are actually pretty bullish moving forward. And so as you can see right here, 1 month out, positive 65% of the time. 3 months out, positive almost 90% of the time. And part of the reason that could certainly be is the way this data set is structured, that typically tends to kind of be a first pullback after a big move, which usually doesn't end in a major correction. It ends bouncing at some point in time and heading higher. So that's kind of what this data set here is showing us. So if we take a look at these data points, the U.S. dollar a month or two out from now, after what it's just done, has a good chance of actually being lower, and the overall market has a decent chance of being higher. Of course, as we talked about in the beginning of this video, it's really going to be important what levels hold on the S&P 500. So we'll continue to need to pay very close attention to that 3,200 level, see if we can hold that on a weekly closing basis. If not, this correction certainly could get a bit deeper. As always, guys, I hope you have yourself a fantastic week. I'll be back next week with another market breakdown video for you guys. As always, if you have any questions, comments, you want to reach out, talk anything about the stock market with me, you can reach me at mtedeschi@perspectivewealthplanning.com or give me a call at 814-580-9881. Have yourself a fantastic week. Take care.